If you're waiting for the real estate market to crash or you're hoping it suddenly turns back into 2021 overnight, 2026 is probably going to surprise you and not in the way that most people expect. Hey everyone, welcome back. Today I want to make more time than usual and really unpack what actually happened in the real estate market in 2025 and what the data suggests we should realistically expect as we move through 2026. This isn't surface level update, and it's not based on opinions or headlines. We're going to work through the market in layers, so everything actually makes sense. First, nationally, because that sets the backdrop. Then Chicagoland, because our region behaves differently than much of the country. And finally, we are going to zoom all the way into the western suburbs of Chicago, specifically Yorkville, Batavia, and Sugar Grove, because this is where decisions are actually made. Stay with me, because once you see how these layers connect, the market becomes far less confusing and far more predictable. Let's start with the big picture. 2025 was not a crash year. It was not a rebound year. It was more like a reset year. Mortgage rates spent much of 2025 trending lower compared to where they started, but they remained high enough to meaningfully impact affordability and behavior. That combination is important. Rates dropped fast enough to spark a surge of buyers, but they also didn't rise enough to force sellers into panic. What we saw instead was a hesitation. Buyers didn't disappear, they slowed down. They recalculated payments, they compared options, and they became far more selective about what they were willing to move forward on. Sellers didn't rush to list either, especially homeowners who locked in low mortgage rates years ago. Many of them simply chose not to move unless it made clear financial or lifestyle sense. Nationally, home prices continued to rise through 2025, but at a much slower pace than previous years. By the end of the year, national price growth averaged just over 2%. That number is critical because it tells us the market was neither overheating nor collapsing. 2% growth in the market absorbing higher rates while still dealing with limited supply, it's a signal of stability under pressure. But that price growth did not happen evenly. Some regions, particularly parts of the South and West, like Florida, Arizona, had experienced rapid appreciation earlier, saw prices flatten or dip slightly last year. Meanwhile, such much of the Midwest and Northeast continued to experience modest appreciations. This divergence matters because it explains why national headlines often feel disconnected from the local reality. And at the same time, inventory did begin to rebuild. Not rapidly, not dramatically, but consistently. Active listings were higher than a year earlier, which gave buyers more options and reduced the urgency that defined the pandemic-era market. Sellers, in turn, faced more competition. Homes were no longer guaranteed to sell just because they were listed. Pricing strategy, condition, and presentation suddenly mattered again, and for the first time in years, mistakes were visible. This is where many people will get tripped up because what happened nationally in 2025 does not lead to the same outcome in every local market. That's where headlines stop being helpful, really, as we move into 2026. The national data points towards a market that is steadier, more predictable, and more balanced. Mortgage rates, they're expected to ease modestly, not collapse. Home prices are projected to continue rising, but at a measured pace. Affordability is expected to improve slightly, just a little bit, not because homes become cheap, but because wage growth is projected to outpace home price growth. That distinction is important. Buyers are not suddenly gaining massive purchasing power, but they are gaining breathing room. Inventory is also expected to continue rising in 2026, though again, slowly. We are still dealing with a long-term housing shortage that was years in the making. New construction is projected to remain below historical averages, which means supply constraints are not going away. Nationally, 2026 looks like a year where buyers have more leverage than they did recently. Sellers need to be more intentional, and negotiations become a normal part of the process again. But the most important takeaway is that local markets will behave very differently depending on fundamentals. That brings us to the Chicagoland area, the local area, because this is where the national narrative really starts to break down. In Chicagoland during 2025, median prices rose modestly, closed sales actually increased, and sellers on average still receive just over 98% of their original list price, their original asking price. That combination tells us demand never disappeared. It just adjusted. Buyers became more cautious, more analytical, but they were still active. The data shows fewer emotional decisions, fewer bidding wars, and longer decision timelines. Homes that were priced correctly and aligned with buyer expectations still sold. Homes that were overpriced or poorly positioned sat sometimes long enough to expire or require price adjustments. This disconnect became what people hear nationally, and what is actually happening locally becomes even more clear when we zoom into the western suburbs, because this is where real estate becomes hyper-specific, hyper-local. Decisions are made, town by town, neighborhood by neighborhood. So if we slow down even more and zoom in even more through Yorkville and Batavia and Sugar Grove individually, we'll see some differences. Like Yorkville, it remains one of the fastest evolving markets in the western suburbs, largely driven by growth and new construction. Buyers are drawn to Yorkville because it offers newer homes, larger lots, and more space for the money compared to closer suburbs to Chicago. In 2025, Yorkville continued to see steady buyer interest, but urgency faded. Homes did not sell instantly like they did in peak years, but pricing held up when homes were positioned correctly. Buyers became more selective, comparing subdivisions, evaluating commute trade-offs, and paying closer attention to the actual condition of the home. Newer, well-maintained homes priced realistically still moved. Homes that needed updates and were priced based on peak market expectations often sat a little longer, not terribly longer, a little longer. But heading into 2026, Yorkville is shaping up to be a balanced market where buyers have options and sellers who price strategically can still succeed. Yorkville continues to attract move-up buyers, relocating families, and buyers that are prioritizing space, school districts, long-term value. It's not a speculative market. It's driven by lifestyle. It's driven by affordability relative to nearby areas. Batavia, on the other hand, behaves a little bit differently. Batavia is more of an established market with older housing stock, a strong downtown area, limited room for large-scale development, and proximity to employment corridors. In 2025, Batavia showed strong price stability and consistent demand. Homes did not sell overnight, but sellers who priced in line with condition and location still saw strong outcomes. Buyers in Batavia tend to be more emotionally driven. They care about walkability and charm and that community feel that Batavia offers. They're often less price sensitive than buyers a little bit further west, which supports some long-term stability. And heading into 2026, Batavia is expected to continue to see modest appreciation and, fairly steady demand. Batavia is not about chasing discounts. It's about long-term desirability and resilience. Now, Sugar Grove, they sit in a unique position because it's between Yorkville and Batavia. It offers newer subdivisions for the most part, larger lots, quieter, kind of semi-rural feel for now, which still is, maintains reasonable access to Batavia and Yorkville and shopping centers. In 2025, Sugar Grove benefited from buyers looking to stretch their dollar without moving, as far south as Yorkville, because Sugar Grove has fewer homes overall. It's a smaller community. Changes in inventory will have bigger impacts. And when desirable homes come to the market, they still do attract strong interest. However, pricing did matter greatly in Sugar Grove, especially for homes competing with nearby new construction. Heading into 2026, Sugar Grove is shaping up to be kind of a precision market. Well-priced, well-maintained homes will perform well. Homes that miss the mark on pricing or maybe condition, they're going to tend to stall a little bit. And when we compare these three towns side by side, the differences become clear. Yorkville is driven by growth, new construction, better value per square foot. Batavia is driven by stability, established neighborhoods, long-term appeal, downtown walkability. Sugar Grove sits between the two, offering space without sprawl, mostly newer homes without massive development. And these towns are close geographically, but they all kind of behave pretty differently. And that's why pricing, timing, strategies in each of these towns, and if you expand that to the towns in the suburb, are town specific. Blanket advice will just miss the mark. So as we move through 2026, the market is not defined by chaos or panic. It's defined by clarity. Strategy will matter again. Pricing strategy. Local knowledge matters again. And informed decisions will consistently outperform the guesswork. So if this breakdown helped you, make sure to hit subscribe. I break down real estate trends specifically for the western suburbs of Chicago. Drop a comment. Tell me which town you want a deeper breakdown on next. And make sure to watch the next video, because I'll walk through exactly how buyers and sellers can win in this coming market.